Welcome to the June Amati Insights. I'm joined by Jourdan, my colleague on the UK equities desk. Before we start, please note on the screen we've got some important information. None of what we're about to discuss should be taken as financial advice. So, Paul, we're June already. We're midway through 2025. UK indices, large and small, are up year to date, but still on significant discounts, especially to the US. What are the driving factors?
Yeah, well, what a year it's been. It's been such a roller coaster with and I guess you and I have been, and our team have been sounding a little bit like a broken record over the past year, saying, well, we're nearly at the end of this downturn. We're nearly at the end of this downturn. Not sure what's going to turn it around, but something always comes along. And sure enough, it's been a wild ride, but Liberation Day, it turns out, is has been Liberation Day in part for the UK market. And I think people are going to look back at this very confusing period and look at what the US is doing and just count the number of own goals that's going on and beyond really what anybody could possibly have expected. And I think most UK small companies, like investors like us, have now got much more of a smile on our faces than we had 3 months ago. And I think what we've also been saying for some time is it won't take much to turn this market and to turn sentiment, because really everybody who wanted to sell has sold. And we are down to the kind of, die-hard core investors who believe in this market, who believe in the companies, who want to be there for the long term. And a few marginal buyers coming in are going to make a massive difference. And we can go on and talk about, well, who are those marginal buyers? But one of little story which might be interesting. It was one of an analyst I was speaking to on one of the companies that we used to hold in, and we don't actually hold it right now, but OSB, a significant, very interesting UK bank, specializes in buy-to-let mortgages. They just got taken on a US roadshow, and the broker was thinking, oh, how are we going to fill all these slots? It's 4 days. They immediately filled all of them, half in Canada, half in the US. Spent a lot of time in New York, and he was telling me that the New York investors in particular had studied this in great detail, really knew the company well, and at one point asked, well, how much of your share capital is owned by US institutions? And they said, oh, well, we're not sure. We better look that up. But we guessed 10 to 20%. And they went away and looked it up, and it was actually 60%. And obviously, a lot of that is trackers, which get registered in the US. But the idea that the US investors are not going to invest in the UK, that's nonsense. We'll talk about AIM in a minute. There's an idea out there that US investors won't buy AIM listed stocks. I'm very skeptical about that. I think they buy the companies they want to buy, and they don't really differentiate. Maybe there are some who won't invest in AIM because it's a bit too complicated. But
yeah, it feels like one of the twists of the Trump unpredictability is that we're seeing UK small and mid-cap companies where they've now got US and European institutions who are appearing on the register, and I think these funds are screening small caps globally, and I think it's interesting that the UK constituents are the one that are coming to the top of the pile. But you mentioned it briefly there. The AIM listed companies, and the AIM is up year to date, but it has sort of lagged behind some of the larger indices. What do you think's causing that? I mean, AIM for a long time has been the go-to index for sub £1 billion growth companies, and it was always eventually companies would look to graduate into the 250, when it was appropriate. But the pace at which they now move to the main list seems to be accelerating. What do you think the main reasons for that are?
yeah, well, something we debated a lot, and it's I find it disconcerting that companies are getting heavily advised by their brokers now. And I want you to comment on this in a minute, because you know the broking community exceptionally well. But they're being advised quite heavily. You'd be better off on the full list. Wouldn't it be great to be in get some tracker funds to buy your shares? And these inheritance tax portfolio investors are dying out. And this is the big topic. So one of the great things about AIM over the past 20 years has been the flow of capital that comes into the market from investors seeking to do this trade-off. You make a riskier investment in a small UK company and you get tax relief on your inheritance tax. And I think it was well understood by government and by investors that this was a fair trade-off, actually. But then nobody was quite sure whether the legislation really intended this AIM to be a beneficiary. But then after so long, everybody just concluded, well, it must intend it because everybody knows that, everybody knows about this. But you can never quite tell with officials whether this is deliberate or not. And then, of course, we had the move last year in the budget to halve the rate of tax on AIM. And actually, as it turns out, this was not well done. But to be fair, the legislation is not yet published, so major uncertainty still runs over this till we see the legislation. But the key criticism, I think, that AIM investors would have of what was done is that the tax relief was reduced on AIM companies, but not reduced on private companies. And this actually presents some major problems. And sure, there was a £1 million limit introduced on private companies, but the twist in the tail here, and I don't think any officials in Treasury or members of the government who were policymakers understood this at the time, is that alongside AIM inheritance tax investment, which I think there's a fair trade-off between risk and reward, there are some pretty massive private inheritance tax schemes out there, or services is what they're called. And people who look into this part of the market hard, as I've had a reasonably good look at it as a financial analyst, and I think this is potentially a big accident waiting to happen, and there was not much awareness of this really in government circles. I think there is now, and the awareness has improved a lot. I suspect there'll be pretty heavy lobbying going on to try and not let the government go after this. But I also think there's a big risk the government does go after it. So, if you're a financial advisor thinking about this, would you really put your client's money into a private IHT service? It's so tempting because you can say, well, your money doesn't feel like it's at risk because these are just buying solar farms and wind assets and lending money in secured loans, and it's all very low risk. But the problem is that is the exact problem. It's all very low risk. So there's no trade-off with the taxpayer. There's no benefit to anybody really from these things existing. It's not a good allocation of capital. They're buyers for all of these assets that they own just for their income streams, but possibly at lower prices. So in fact, if this gets attacked, what will turn out is you overpaid for these assets. The pricing, they're all private, so the pricing is very opaque. One thing that makes it suspicious is that the NAV of these services goes up a little bit every month. And anything where that happens, one needs to be suspicious, unless it's a risk-free government bond, which this isn't. And then, the most profound question I think anybody who's an advisor who wants to allocate to that needs to answer is, can you honestly say that these are not going to fall foul of the anti-tax avoidance legislation? And that's possibly the killer. And, when I started thinking about that through, what would it be like if it turned out that HMRC decided to have a go at these as tax avoidance schemes? It would be utter pandemonium. But ironically, it would be very good for the AIM market, because right now this is like a little plug that's opened up out of the AIM market, and some advisors are thinking, well, why we only get half the tax relief on AIM and take all this risk when there's these very nice private schemes over here, apparently no risk. But I just counsel, well, there's big tax risk, and there is risk in the investment as well, because you're not overpaying. If that plug were to get sort of put back in, and we would start to see some investment coming back into AIM just for half the tax relief in inheritance tax, it's perfectly legitimate and sensible trade, especially now. It's as long as you kind of want the government to say, well, we're not going to mess around with it again. This is actually how it's going to be for the long run. You can rely on this. That would be very positive for the AIM market. And if that then also led the advisors to stop telling these companies to move to the full list prematurely. It's fine if you're £1 billion plus and you're going to go into the mid 250. If you're a £250 million company, it doesn't really make any difference if you're on AIM or the full list for most investors. And the trade-off between inheritance tax investors and trackers is pretty neutral, probably.
So
Yeah,
potentially something that HMRC could revisit in time. And the other sort of regulatory driver that I thought was quite notable was the Mansion House Compact, which is the update from the previous Mansion House Accord, and it's trying to encourage some sort of local authority and pension funds to invest more in the UK and more domestically. And the phrase they've used is to invest in private markets, but private markets includes AIM. So do you think this could be the sort of white knight that comes to rescue AIM? Because if you're running a county council pension fund, the AIM companies are obviously listed. You can see the price every day. They're very transparent in the way that they report. Is that not more appealing than maybe going down the private equity route where you're potentially locked in for a number of years?
yes. I mean, yeah, but pension funds have always been aware that they can take liquidity risk if they need to, so they don't mind being locked in particularly. But having said that, private equity feels like a pretty crowded trade, and there is this, I think policy blindness at high levels where it seems to be, private assets are just fine. They're as good as listed assets. They're absolutely not. When you take a company private, the first thing you do with it is you stop it paying tax. And
Hmm.
we've been looking at a company that the old Melrose team are buying this morning. They just announced a deal. It's a US company being bought out. They're buying it out of private equity. Funnily enough, that company is loss making. Why is it loss making? Because it pays a massive amount of interest on very high leverage. That's the first thing you do in private equity.
Hmm.
It's terrible for government actually, and it's terrible for for the general financial system and the sort of public finances to let too many assets just go into private hands, into private equity, because your corporate tax receipts get killed. And I'd say this the most consistent feature of any company gets taken private is the next year it'll get bound up in this, that, and the other, and taken to some offshore holding company, and you'll never see any tax revenue from it again until it gets sold. So it is the most surprising thing and the most slightly frustrating thing about this Mansion House Compact is the slight obsession with private assets. And I think actually the focus really needs to be on protecting public ownership of companies and the whole concept of a stock market. So it's fantastic news, though, that the sort of slight kind of get out here is that AIM qualifies as private assets, and we've just got to hope that the pension funds who probably don't really want to stick a load of money into private assets if it's not what they were doing already. But the intention here should be about getting them to invest in the UK. And it's somewhat astonishing to me that the government's pressure here is to invest just in private assets, and only half of them need to be in the UK. I don't understand that.
Hmm.
But even half of them coming into the UK and some of them coming into AIM, the market is really on this kind of it's like dry tinder. It don't take much to have some really good sparks appearing and small sparks changing the momentum in the market. In fact, we're already seeing it, and
Hmm.
that pension fund that's already invested in UK assets has made a difference. It's tangible. I think everyone's already noticed it.
Okay, and turning to the sort of the smaller companies fund, what sectors are sort of leading the charge so far this year?
Yeah, well, I think you should come here, Gregor, and talk about defence because it's been a theme in our portfolio for some time, and we've had to wait very patiently through the defence spending review, and it was a little bit painful at times over the past year, but it's really coming to its own in the last month. Why don't you talk a little bit about the
Well,
defence companies we've
it
got?
has, and I think at the last quarter of 24 and Q1 this year, it felt like it was clear that we were going to start to demand more from our domestic defence industry, and most of the UK defence constituents have been acquired. So there are not that many left in UK PLC land, but the ones that we do have very entrenched positions, huge barriers to entry, and long track records of dealing with the defence industry. And it took a long time, but I think the market is starting to see that as well. And of course, we had the Strategic Defence Review earlier this week. And in the UK, that committed us to investing more in naval, to investing more in munitions, to investing more in cyber. And these are all things that Chemring and Cohort and Kinetic, the three that we hold in the fund, are already plugged into. And I think the market's sort of really waking up to the fact that 2 or 3% of GDP across the whole of Europe is a huge number. And suddenly we want this to be looked after much more on the domestic level. And I think these companies are in a great position to kind of help rebuild that defence base. So that's been a real bright spot, and it feels like that will continue because we're really at the start of this process, I think, rather than kind of towards the end.
I completely agree. There's like a decade-long theme emerging there, and these companies were absurdly cheap, and they've now re-rated very rapidly, but it's not finished as a story at all. And just very quickly before we run out of time, we could just talk about a little bit about gold. So obviously, our metals fund is having a fabulous time at the moment. As big chunk of their fund is in gold and silver. Actually, silver was the breakout story yesterday, but gold has been very helpful for our fund too. And we were lucky that at the time we were looking for more exposure to gold, this wonderful company, Greatland Gold, decided to raise a ton of money to acquire an asset in Australia, slightly like a reverse takeover, and suddenly became a really significant Australian gold producer. It's just going to go through this process of turning its primary listing to Australia, which it was always going to do. I don't think that's to do with any, the other stuff we're talking about, AIM. It's an Australian company, Australian management. They know they can get very serious backing in from the big Australian resource investors, particularly if they make the primary listing Australia, but it will still be secondary on AIM. And that one's been a big contributor, but we think actually has a way. It's not reflecting anything like the current gold price. So, there's hopefully some good times to come still in that one. That's been another emerging theme. But lots more to talk about. I suspect we're probably running out of time there.
I'm afraid, Raj, just to finish off then, what do you think will play out in the second half of 2025? Are there any sort of key themes that we should be looking out for?
Well, we'll get more chaos from policymaking in the US, almost for sure. I think the market's sort of developing quite a thick skin to it, and it's becoming more of a show me kind of thing. Well, you can tell me tariffs are coming, but let's believe it when they actually come. And the biggest worry for the remainder of the year is actually, I'd say, the US bond market. I think there's a general belief this triple B bill, which we all regard as the route to the triple B rating for US debt, is not going to get passed, but we'll see. That's a pretty important thing. It's fiscally very highly irresponsible if it does get passed. But insofar as the US gets a scarier place, actually the UK and Europe just look more attractive. So, I think this dynamic that we've just started to see hopefully continues to run in the rest of the year.
Yeah, I think we've touched on it already. I think people are screening small caps and medium-sized companies globally, and you can see the UK is sort of coming to the sort of top of the pile, and I think that will continue. Balance sheets here are in pretty good shape, and we're sort of safe and predictable compared to what could happen in the US, and it feels like that will only continue into the second half. But we're out of time there, so thank you for answering those questions. And if you have any other questions, please do get in touch with us here at Amati.